Hi, this is George. In this video, we are going to see about weekly Banknifty Straddle. Before getting into the strategy, please do subscribe to this channel and join our Telegram channel for instant updates. And please do like the video if you genuinely like it. Let's get into the strategy. So this is an actually an exciting and interesting strategy in option selling. The reason being, in this, most of the time it will be a no loss strategy, or at least with a minimum loss strategy. Our loss will be like a drastically decline after we deploy the adjustments in the strategy. And also the margin required for this strategy is like only 80,000, so which is not so high. So most of us can afford this. So that makes this strategy more exciting and interesting. So in this strategy, what we are going to do is we'll be selling a ATM call and put and buying OTM call and put with the strike price difference of 2000 points. And also here will be like the buy price will be in the multiples of 500 because for liquidity purposes. So for example, if you're selling 3900 PE and CE, ideally we need to buy 3700 PE and 4100 CE, but due to liquidity issues, we'll mostly buy 37,000 PE and 41,000 CE, as the multiples of 500s in strikes of Bank Nifty will be more liquid than the others. And in this strategy, I have done manual backtesting for the last 16 weeks in Bank Nifty straddles, and I'll be sharing the results in a little while. And in this, only one set of adjustment is required. So it is very much suitable for working professionals and part-time traders who can't spend most of the time in the trading terminal. Disclaimer, this is just an educational purposes. Please do your research before taking any trade. This is not a recommendation, but just my view. So let's get into the core of the strategy. So when are we going to enter into the strategy? So ideally, we'll be entering on a Tuesday of the previous week expiry at 9:30 p.m. Say suppose we are going to do the strategy on, say, for 28th of April, we'll be entering on 19th of April. That is like previous week's Tuesday. Similarly, if you are going to do for 21st of April, we'll be doing on 12th of April. Similarly for every other week. So that is the entry time. And morning 9:30 we are going to enter. The reason being, the time decay starts well from Tuesday. From Friday and Monday are the days where we don't have much time decay. It doesn't mean that always, but most of the times time decay starts happening only from Tuesday. And also, like, so Tuesday morning we are taking, because we don't want any, like, we can even take on Monday evening, but if suppose there is a gap up from Monday evening to Tuesday morning, so better we are avoiding that and we are taking the trade on a Tuesday morning. That is the reason we are entering at Tuesday 9:30 a.m. I have mentioned as PM, sorry, it is a.m. And we are exiting the contract mostly by the expiry day's last day at 3 p.m. That is almost the expiry time. So adjustment rules. So once we enter into the trade, we check every day by 9:30 in the morning to make adjustments if needed. So when we'll do adjustment is like we do adjustment only after that week expiry gets over. We are entering the previous week's Tuesday, right? So that week's expiry will be on a Thursday. So once that Thursday is over, that Friday. So as I told, let's see from the calendar. So say for the week of 21, we are entered on 12th. So maybe like after 14th, 15th, actually this week 15th was a holiday. So we'll be like doing the adjustment on 18th. Let's say like for say suppose, let's see previous one maybe. So for 24th of March, would have taken the trade on 15th March. So for that, the adjustment we'll make is like after 17th expiry gets over. So 18th morning, we will be doing the adjustment for the 24th week. So that is how we are going to do the adjustment in this strategy. And what is the adjustment? The reason is here because in these 3 days, the time decay would have happened if market has not moved so much, like if has not moved 2000, 3000 points, and if it is little range bound in the sense I'm not making it like only 300, 400 point move, even if it is like 1,000 point move also, even that can be considered as a range bound. And once in that case, we will already have some little profit, and that time we are going to make the adjustment. And what is the adjustment? The adjustment is like we'll be like closing the hedge on both sides that we have bought. That is, we bought already 2000 points far away out of the money call and put. That we are going to close, and we are going to buy hedges 500 points from our sold call and put. So ATM call and put we have already sold. From that ATM call and put, we are going to now buy 500 points from the sold call and put. This is again far from the what we have sold, but it might be in the money already, but that doesn't matter. We are going to buy hedges both the side with this price. Say suppose for the example that we saw before, we had a ATM of 3900. So wherever the market is, maybe the market may be now for 40,000, or maybe it is at 38,000, or let it be at same 39,100. We are going to close those two legs, that is 37,000 PE and 41,000 CE, and we are going to buy 39,600 CE and 38,600 PE. So once we do that, I'll just show you the graph in the simulator. We'll be either in a no loss zone or very minimal loss zone. Our maximum loss would have either vanished totally or would have drastically declined. I'll go to the simulator and tell you like how this would have happened. So this is for the last week, that is like 21st expiry. So 12th of April we are entering. As I told, for 21st we are going to enter 12th Tuesday. So at 9:30 we are entering. At that time market was at 37,300. So we'll be selling ATM 37,300 call and put, and 37,300's nearby is 37,500. So 2,000 point is 35,500 put we are buying, and 39,500 call we are buying. Now we'll be seeing after expiry. So 13th was the expiry that day, because 14th was a holiday. 15th was also a holiday. So Monday morning we have to make the adjustment. So Monday morning, as I told, like already we have made like only 400 points different. Okay, but we are already in a profit. So what we are going to do is, like as I told, we are going to close these two legs. The hedge we bought 2,000 points away. So in this case, it is like 54 rupees we are buying back, and this at 8 rupees we are closing, and we are going to buy 37,800 and 36,800. Where is 37,800? 37,800, 36,800. So once we do this, our payoff graph will start showing something like this. We'll be already like without any loss. Maximum will be ending up with 2,000 profit, though we already have 4,500 profit. Still, our maximum profit is going to be 14,000 or whatever, but we are not going to get into loss anyway. So from that we can, like, either if you want you can hold till the end, or if you find any place, suppose here we are getting 5,000, maybe if you want you can close it, or you can wait till the end. That is totally up to you. Maybe this market has moved far away, so maybe you can close at even 3,000, or if you think okay it might go till, also you can wait till 3 o'clock. But actually in this case at 3 o'clock it has went to only 1,300 was our profit. So this thing didn't happen, but that doesn't matter. Anyway, you are not going to lose any money. Let me show some other example where you was like maybe 14th April, like previous week of the one that we saw. So for that we are going to enter 5th of April, and that is for 13th of April expiry, because 14th was a holiday. So we are going to enter at 38,500 on Tuesday 9:30. 38,500 we are going to sell call and put, and we are going to buy 36,500 and 40,500. So this is how your payoff graph will look like, where your maximum profit is 25,000, maximum loss is 24,000. So it is like a risk reward ratio is almost like 1:1. So we might either get a profit or we might lose, but this is a little difficult scenario, like the usual strategy that we create. But let's see how it changes when we do the adjustments. So as usual, we are going to see after the expiry. The expiry for this week is 7th, so we have to see till 8th. Let's see what happens. Look, we are already in loss. So 1,400 we are in loss, and market has moved almost 1,000 points. Doesn't matter, not a problem. So now as per our rules we are going to close these two legs. Just remember this, like max loss is 24,000 and max profit is 25,000. We are going to close these two legs. 139 this is trading at, and this is trading at 11 rupees, and we are going to buy back. It is 38,500, right? So we'll be buying 39,000 call and 38,000 call as per our rules. 39,000 call and 38,000 put. So once we do that, if you see the payoff graph, totally it becomes like this. Our max loss is reduced to only 3,000. Our max profit also has reduced, but that is fine because anyway the loss has diminished so much from 25,000 or almost 24,000 to 3,000, and this also like from 23,000 to 9,000. But anyway, if you are like, if you know that your loss is not going to be 3,000, you can take some risk, or you can take some other reference trade or whatever to make your thing to profit. So let's see what it happens in the next 2-3 days. So here if you see, that day even it has opened at only somewhere around 1,000 rupees loss, maybe you can book it off, or you can wait, or you can do whatever adjustment if you want, you can do. But the thing is, like, your loss is reducing here. That is the main thing that I want to say. There can be some situations where you can make very good profit. Say suppose for example we'll see 24th of March. So for 24th of March, ideally we will be taking the trade on 15th of March. Expiry is 24th of March. Here again 24th of March at 9:30. It is almost 35,500. So let's sell 35,500 ATM call and put, and buying 33,500 put and 37,500 put as per our rules. Now we are going to go day by day. So our expiry for this is 17th. So 18th only we will be making adjustment. So here we are already in 3,000 profit. Market has moved almost 800 points. Okay, doesn't matter. So we are going to close these two legs. This is at 25. This is at almost 120. And we are going to buy back 36,000 call and 35,000 put. 36,000 call, which is 500 points from what we sold, and 35,000 put. So once we do that, our payoff graph is going to be like this, where we'll, our maximum, like minimum profit will be at least 2,000 almost, and maximum profit can be almost 14,000. So we at times get jackpot. So if we like go like day by day, we see that on 24th of March at almost 3 o'clock, if we had holder, we got almost profit of 11,000 or 10,000. So it depends. If you want, you can hold, or maybe somewhere around 8,000, 9,000, you can close, also close, whatever it is. But if when you know that you are not going to go into loss, it's up to you totally, like whether you want to hold it or if you want to like us close the position, or it's totally up to you. So in this case, I have given us like a 11,000 profit. Similarly, if you see a day where you had the maximum loss, so let's see on 13th of January. So let's see what happened on that day. 13th of January. So you'll be entering on 4th of January and 13th of January. Again here 13th of January, 9:30 we'll be entering. 36,600 is our ATM. So 36,600 will sell a call and put, and nearest to it in multiples of 100 is 36,500. So 2,000 points away from 36,500 is 34,500 put will buy, and 38,500 call, let's buy. Now in this case, let's see, expiry is on 6th, so still 7th we need to wait. So we can see like market is already going so much away. Okay, so it is almost 8,000 loss here, and it has moved almost 1,400 or 500 points. That is the reason we are getting a very big loss here. And our maximum loss in this case again will be like 29,000. This is just on this day the T+0 line is showing our loss to be 8,800. But suppose market remains this in this same place, and by next week, that is 13th of January, you can see that the loss will be like somewhere around 15,000 also, or 16,000. So as per our usual strategy, the rules that we follow, let's close these two legs at 10 rupees and 259 rupees. So once we do that, then we have buying back 3700, which is 500 points from this old one. 3700 call and 3600 put. So once we do that, again our max loss has gone to only 10,000 and our max profit is 1500. So that scenario we saw, like our max loss can be even 25,000, but here it is not so. And say suppose if it is market is reversing, and you might end at 1500 profit also. You say suppose if market reverses and if it goes to 36,500, which is 1500 points from here, which might or might not, but still you are limiting your losses. So let's see what happens. Actually, it didn't happen, and we end up at the maximum loss. So if it is like max loss is only 10,900, here it will be showing so 10,900. For that only I have given here as 11,000 loss. It can happen. So, but out of the 16 weeks that I have taken backtest, this is the only week which had maximum loss. And again, this week was also a bigger loss. You can see that at your own time. So out of those 16 weeks, actually it's 12 here, 11 here. I mentioned it wrongly. Sorry for the inconvenience. Five, the highlighted ones are the only one that are in loss. So 5 weeks are loss. Number of profitable weeks should be ideally 11. So percentage of profitable weeks is 11 by 16, which is 69%. Overall profit, if you add these up, it will come around 27,300. So average profit or loss per month is 6,800. So return on investment per month is like for 80,000, you're getting almost 9%, which is a very good return per month. So this is a very good strategy for less capital. So main thing in this strategy, what I like is, so once we see a payoff graph like this, we'll be like stress free for an entire whole week. Like Friday morning, when you see a graph, when you have your strategy is not going to make any loss, that time you can be like so relaxed and you can take some reference trades, keeping this as base trade. You can take reference trades, say suppose like if your market is, let me show some example. Say suppose, let's say these are all like in green. Let me just take some, okay, we'll consider these are all in green zone. And if your market is here, maybe you can sell somewhere around 1,000 points away from this left side, like in a put, maybe 20 rupees make a put you can sell, or you can sell a spread, or you can do a ratio spread where we can buy one put and you can sell 2 3 puts. You can do so many strategies keeping this as base trade, and you can still make more money than what I have mentioned here. That makes this trade strategy more exciting, interesting, because once you are stress free, your mind also will be relaxed to think on what else we can do to make mint more money, because we are in stock market only to mint money and not to see whether our strategy is working or other strategy is working. Whoever strategies is working, let's just learn that and implement that. That's it. These strategies, the straddle and strangle or whatever it is, this will be same wherever, whichever video we go and see. So what we need is like, as per for me, it is like, as I am a working professional, I want to see some strategy where there will be very less adjustment and we still need to make money. That is the only reason I am here for in stock market. I guess that is the reason everybody is as well. So let's stick to strategies that is more comfortable for us. And once we are stress free, we can use other strategies as well and to make to mint more money. So, and say suppose in this case, our market was always going against us. That is like it was never range bound, it was keep on moving in the opposite side. Same side. That is like it was trending in one side. In these cases, if market move violently in the first 2 3 days, then for that expiry we can do trades based on base trade as well. So which is what I'm trying to say here is like, so this trade we took on 4th for 13th of January, but we saw like 5th and 6th were like it is going against us. So in those cases, maybe for the 6th expiry, when your market was somewhere around, maybe in this range, it might be 37,300. And if you wanted market to come downwards towards your green zone, so maybe you can sell put options here, maybe a naked put or whatever, because as it is a expiry day, time decay will be more on that expiry. That is 6th of January's expiry. The time decay will be more. So for that expiry, you can sell more put options. So either you will make money on that expiry, or if suppose it comes back and if you make a little loss, you can always keep a stop loss and exit. If it comes back again, your this strategy again is going to give you a profit, because you can close that and you can like close these two legs and open that time will be in profit, no loss zone again for this 13th of week of January. So like this you can do for that week or next week or even for month, and whatever you want you can do, and you can make more money. For this strategy is so flexible. So I like doing this strategy. So it's recommended. Like if you like, you can always try doing this with whatever strike difference or whatever adjustment that you want to make. This is so flexible that it is very easy to learn, and it's not very much complicated as well. So in next video again we will see some other strategies. Thank you.